Well, MVP Aaron Rodgers took a trip to Disney World on Monday after the Super Bowl, and he's one of just many recent visitors. Disney's theme park business grew last quarter for the first time in more than 2 years. So that strength, along with a boost in ad sales, helped fuel a 54% jump in profits for the media giant. David Bank is with me now, right here in the newsroom. He covers Disney stock for RBC Capital Markets. David is a Bloomberg best. So, David, the first quarter's so good. You're raising your earnings numbers for the year. What parts of the quarter really stuck out?
Everybody knows that ESPN is just ripping it right now. I don't think we expected a 33% increase in advertising.
So better than you even thought.
But I mean, you know, in the 20s, it just keeps getting better. I think the bigger surprise is what's going on at the parks. And we expected attendance to be up. What we didn't expect was per cap spending.
Because you were even a little bit lower than the street, right? So you weren't expecting this kind of blowout quarter for the parks. So what changed, do you think, or where's the surprise?
The big number was the per cap spending number. So people going to the parks spending 8% more when they're at the parks, which means as Disney's pulling back its discounts, attendance is not suffering, and people are spending more, and we just see the trend accelerating.
Well, speaking of spending and money, I mean, ESPN, you alluded to it, has been a cash cow for Disney for years, and as you said, even did better than Wall Street consensus for this first quarter. But what about an NFL lockout? I mean, what if that happens? What could that mean for ESPN, or even basketball, NBA lockout?
Sure. Well, on many levels, a frightening concept. We've written a lot about how this season, really the only thing besides MTV and television that's worked is the NFL. Professional football has been a monster. Ratings increases have been fantastic. So it would be devastating to lose that programming on multiple levels. The NFL directly, nothing to watch, but then the way it lifts the schedule generally. Our view is we're really not that worried about an NFL strike, not to be that cavalier, but the NFL is the most socialist of all the professional football leagues. All the owners are making money. It's kind of tough to want to lock out if you're all making money. The NBA, on the other hand, is something we worry about much more. Their collective bargaining agreement expires in June. You got a lot of teams that aren't making money. Maybe more likely, we're not saying it's going to happen, but it's more likely than the NFL to have a lockout. And that would not be good for ESPN. Is
it possible to quantify just how bad it would be? I mean, can you say it's worth X cents per share on earnings?
Yeah, I don't think we're quite there is the short answer, but you could be sure that the stock would be hit.
All right. Now, speaking of content, we know that Disney entered a 12-month agreement in December with Netflix. So Disney got a little cash off the deal, $200 million. But I know you said you personally wouldn't have done the deal. I mean, are you concerned that viewers would go more towards Netflix and maybe just separate themselves from Disney?
Well, I think generally think about, you know, I have little kids, and if they're watching a rerun of Sweet Life and Zack and Cody, it's kind of indifferent to them whether or not it's a first run at this point. So I think what makes me concerned, I think a lot of media investors concerned, is that you have a $9.99 alternative giving you a product that's just as good as your $60 a month cable bill, you know. And that's the danger in giving content to Netflix, is you pull people out of the existing ecosystem, which pays you so much money, and you kind of push them into Netflix. So long run, that's not a positive for me.
David, thanks so much for coming in, talking to us about Disney's earnings. David Bank joining us there. He covers Disney at RBC Capital Markets. David is a Bloomberg best.